Hello everyone, Jason Gordon, AmeriFirst Financial. It is April 1st, 2020. This is not an April Fool's joke. It is me attempting to record my first video. So bear with me. I'm just going to go do it and we'll see how it turns out. Forgive the skull cap. I'm well overdue for a haircut, as I'm sure many of you are. So I'm covering up out of respect for all of you. A couple updates on the personal and professional side of this video. Mostly professional, but personally, we're being safe, we're bunkering up, we're staying out of harm's way, obeying all the stay-at-home laws and requests and policies. I spend a lot of time in my waking hours working from home, and then when I'm kind of relaxing, recharging my batteries, I'm watching way too much Netflix and Hulu. I really do miss going out to the gym, and I miss going out and seeing you folks in person, eating out in restaurants and all that fun stuff socially. So hopefully soon enough we'll all be out and we'll see each other again. And just want to wish all of you in the meantime nothing but the best of happiness and health to you and your families. So on to the mortgage industry. I have some updates for you, and I want to really help all of you understand what's going on here. Now, I'm not going to tell you how to think. I'm not going to lecture you, and I'm not going to get political, but please remember, we live in a society right now where we get fragmented information. We believe things to be true without hearing it in context, and many of us carelessly share this information on social media, and it perpetrates the misunderstandings. The mortgage industry has a lot of misunderstandings. I can't tell you how to think, I'm not going to tell you how to behave, but just be aware of all the actions and inactions. There's a cause and effect for everything. So I put together a quick presentation for you on the COVID-19, the ongoing impact on the residential mortgage industry, and it is really ongoing. It changes daily. And I like to begin with a little quote from an old favorite. It's like deja vu all over again. Okay, a lot of this feels in some ways like the 2008, 9, 10, 11, that housing crisis, that market crash, that mortgage meltdown, whatever you want to call it. We're starting to feel some things that just feel a little bit similar. And I want to address them early. I want to be proactive. I want to help all of you be smarter. You're welcome to share this information if you like. I mean well by it. And I will tell you that the industry that I work in is one of the single most misunderstood industries out there. So real quickly, some changes that are going on right now. I put a few of them on there just to give you an idea of what's going on behind the curtain in the mortgage industry. Appraisals, the protocols are changing, and I'll go into that in just a moment here. Verifications of employment, asset verification, the way creditors report to the credit bureaus about your payment history. This desire out of nowhere to have notaries sign people remotely without being in front of them in person. The IRS does what they want to do, and they have just now told the banks they're not going to send the banks what we call IRS tax transcripts, whereby we cross-reference the tax returns you give us with what you filed with the IRS to make sure that those numbers match. Okay, and then of course, all these industry professionals, real estate, mortgage, title, escrow, everyone's suddenly working from home. Not everyone was set up to work from home. A lot of these folks have kids that are now being sent home from school indefinitely, and there's a lot of changes going on in the marketplace as a result. Now, appraisal changes. Of course, we all understand why we would not necessarily want a strange person to walk into our house to conduct an appraisal. I have a lot of friends who are appraisers. They feel the same way. They don't want to walk in your house either. But as we know, to get a mortgage loan, it usually requires an appraisal to review the collateral. I'm not going to go over this chart in detail, but I'm showing this to you to help you understand that there are changes that are constantly being made. A lot of these changes, by the way, in this entire theme for this presentation today, is that this is not just me, my staff, or my company making these changes. I work for AmeriFirst Financial. We are a direct lender. We work with lenders throughout the country, and a lot of the programs that we are abiding by, a lot of the principles of this video right here are going to be from Fannie Mae, Freddie Mac, FHA, VA. The Fannie Mae and Freddie Mac loans, we call these conforming loans because we conform or we adapt to the guidelines of Fannie Mae and Freddie Mac. So a lot of this is a summary of the industry to help you become a little bit more aware of what's going on. So when it comes to appraisals, the takeaway here is that it's on a case-by-case basis whether or not we need an appraisal, and if we do, whether or not that appraiser needs to walk inside of your home. It's an ongoing, evolving process. It's changing. It's a case-by-case basis. It is not perfect. We're working through it, but we are seeing some folks out there who are getting appraisal waivers, thank goodness. Employment verification. You may not know this, but it's standard practice for a lender before they let go of the money and fund that loan. They want to take one last verification to see if our borrower or borrowers are still employed. Okay, pay stubs are historical. W-2s and tax returns are historical. We want to know that employee is still at work. And of course, in this current environment, a lot of people are being laid off. They're being furloughed. They're being, they're losing their jobs altogether. This is creating a lot of problems right now for us to make sure that employees are there. So if you can hang on, please hang on as much as if you can, of course. But stay in contact with me if I'm working on your loan. If you're working with someone else, stay in contact with your lender to make sure that they know what's going on because they are going to check. Asset verification. Okay, there are certain situations where we lenders need asset verification. If you're buying a home, we have to source and season that money. So if you're bringing $100,000 in to buy that home, we want to know the source of it. We want to know where it's been the last 3 months. We want to now make sure that that money's still there. Of course, if it's been in your 401k, it's been in your investment accounts, it may not all still be there. We lost a lot of ground in our market currently with stocks dropping very rapidly. There are certain programs that require what we call post-closing liquidity or cash reserves. After all the smoke clears, how much money do you still have in the bank? And can we use that money in the bank to cover a temporary absence of work and make your mortgage payments? We want to still check, and if your assets have dropped too much as a result of the market, this could be problematic. Now, forbearance. Before I go into this, the deja vu that I'm feeling right now with 2008 and the whole mortgage meltdown and housing crisis, we had a phenomena back then where everyone was telling everyone advice. But who were you getting your advice from? And was that advice strong and accurate? And of course, when you followed the advice and you found out later on that it was not good advice and you wanted to kind of complain to the world, did you really have a right to complain? Or at some point, did you need to be a bit accountable for the fact that you got advice from the wrong person you did not verify and you went down a path that you couldn't immediately recover from? Okay, so the example back in those days where people were stopped making their mortgage payments because they wanted to get the attention of their lender to look at a loan modification, a short sale, a forbearance, a deed in lieu of foreclosure. But when the smoke cleared, we found out that it was not necessarily a good idea to stop making your mortgage payments. Well, now it's fast forward to the present day. Today is April 1st. People have mortgage and rent payments that are due today. The media very irresponsibly is telling everybody, don't worry about making your mortgage payments. You can just ask for a forbearance. First of all, forbearance is not a guarantee. And if it is granted to you, in many cases, it's on a month-to-month basis, and that money is not being forgiven. So in this example you see right here, we have Susie homeowner who's got a $1,000 a month payment, if only, right? But a $1,000 a month payment, if on April 1st she is granted a 3-month forbearance, she makes no payments April, May, or June. Come July 1st, all $4,000 of that money is due. The 3 months that she forbeared and her current July 1st payment all due all at once. And by the way, it is impacting your credit. And so this is the big part here, folks. Please understand, politicians, people on the media are not qualified to give you mortgage advice. I'm in the industry working full time, and I can tell you that there's been no definitive indication from Fannie Mae or Freddie Mac as to what the impact will be of you forbearing your current mortgage and then trying to get a new mortgage anytime soon. So please be aware. It's a very, very sensitive topic. My friendly advice to you is if you have the capacity to make your mortgage payment, please keep paying it on time. And that goes for your other debts as well. And if you're renting, it goes for that as well. There's a cause and effect when people stop paying their payments. Okay, so mortgage programs are changing quite quickly. Most notably here, FHA and VA loans, these government loans that have typically a bit looser guidelines, are tightening up right now. So metaphorically speaking, let's say that you have to fit inside of a box in order to be approved for a loan. These boxes are getting smaller. We're seeing what we call overlays, where an example of an overlay is maybe lender A, B, and C all offer the same program. But lender A says you need a 580 credit score or higher to be approved, or B might say 620, C might say 620, 640 or 660. We're starting to see overlays being put on programs that are making the restrictions higher. Higher credit scores, lower debt to income ratios, lower loan to values, maybe some more asset requirements. These are all potential changes that can happen on any programs right now. So it's already happening on FHA and VA. Non-QM, to keep it simple, is kind of like the modern day version of subprime. Okay, QM stands for qualified mortgage, and non-QM is a non-qualified mortgage. Examples of that are using your bank statements if you're self-employed in lieu of tax returns to qualify, or maybe having some major credit issues like foreclosures or bankruptcies that happened recently and us overlooking them. These programs essentially disappeared overnight, and there's no clear path as to when they're going to reopen again. So if you were approved or have a client that was approved for one of these loans, be aware it might be gone. Jumbo, or what we call non-conforming loans, these larger loan amounts have major restrictions as well, and we're also seeing that the pricing, the rate and fee quotes right now are a little bit off. We're hoping that's a short-term issue, but we're seeing a lot of good buyers or borrowers out there who have larger loans that are being impacted on that. So the takeaway here, folks, changes are happening. Please do not make assumptions. Nobody is entitled to have their way on these situations, and I mean that respectfully. If the bank program changes, the bank program changes. Okay. So, mortgage servicers. Important to know this as well. A mortgage servicer is the company that bills you every month. They may not be your original lender. Let's use an example here. Let's just say Wells Fargo is your lender, yet we'll call it XYZ Company is your servicer. XYZ Company is the one that bills you every single month. You pay XYZ your monthly mortgage payments. XYZ processes your payments. They pay your insurance and taxes on an ongoing basis. They are your servicer. If you stop making your mortgage payments and you take one of these forbearance agreements, XYZ still needs to pay Wells Fargo, in this example, your payment, even though you're not paying XYZ. They have to front you. Well, if it's only you, that's not really a problem. But if it's you and 100 to 2 or 1 million to 2 million other home buyers on the same month, this could be tens of millions of dollars that these servicers have to front on your behalf. And so what's happening here is the servicers are taking on a huge amount of risk. Number one, you may not know this. Most industry professionals don't know this, but these servicers pay up front. They buy the servicing rights for your loan. So XYZ may have paid Wells Fargo a chunk of money to buy your loan, and it takes about 3 to 4 years for the servicer to break even before they start making a profit on you as the buyer, or the borrower, excuse me. Well, with rates dropping as much as they've dropped, people are refinancing over and over again. These servicers are not breaking even. In fact, they're losing money every time you pay off early. Now, I'm not saying you're wrong for refinancing. Refinances, they make sense. Let's do it. And I'm certainly letting all of you know when I'm calling all of you as clients and prospects when rates drop, I'm letting you know, and we're helping you each and every time. But there is a cause and effect. The servicers take a loss when these happen. And of course, now we enter the COVID-19 stage where unemployment numbers are staggering, and we're not even seeing the full extent of the unemployment figures yet. But if people are not working, they are not making their mortgage payments oftentimes, the increase of risk of default goes up, and these servicers right now are in a lot of trouble. So what's happening really quickly in the marketplace? If you ever worked with me before, you've probably seen these charts. We call these candlesticks. Each candlestick summarizes the activity of the market for one business day. This is a 3-month period. Red is bad news, green is good news, and I'm on your side here. The bigger the colored portion of the stick, the more the market moved in that good news or bad news direction that day as a whole. The higher the sticks appear on the chart, the better it is for the quote. So as you can see on this chart right here, over a 3-month period, that first about 2.5 months was a nice, slow, and steady increase upwards. Beautiful, beautiful, nice, better and better interest rates that we're quoting as a result. It was a nice situation. Then we had what I call the worst week ever. These big red downward facing candlesticks were making rate quotes worse, not just overnight between each day, but throughout the day. We'd have what are called midday pricing adjustments for the worst. That's why you see the big candlesticks on there, because these were changing a lot day in and day out. Then we had the Fed on that weekend, on that Sunday, drop in an emergency meeting, drop the federal funds rate by 100 basis points. The media was careless again. They did not differentiate what the federal funds rate is versus mortgage rates. And before you know it, I got blown up on a Sunday afternoon or Sunday evening by a countless amount of emails, calls, text, social media interactions. Everyone thought that mortgage rates were at 0%. Folks, the only way to get a 0% mortgage is if you pay 100% of your purchase price in cash. Okay, there's no such thing as a free lunch in economics. Don't we know that? Come on. So as a result, you see that the market opened significantly higher between that Friday close and that Monday opening. That was a good thing for mortgage rates. We thought we were back, thought we were going to recover from this horrible week over here, but no, we took a downturn, and a major downturn over here, and it got kind of nasty. Brutal 3-day stretch. Got a little better on that Friday. Nice opening on this Monday, Tuesday, and these are kind of the last days where we really were able to lock in any interest rates. Because at some point in time, the lenders stopped following the charts when it came time to do their rate quotes. Why did this happen? Because they got too busy. Can you believe this ad? I pulled this up today, and this is where I bank. Okay, I'm not saying anything disparaging about SDCCU, but look at that highlighted area. And they're not the only ones who have done this. We have lenders that are actually at what they call capacity. There's too much business. They're literally turning away business right now because they can't service the amount of people who want to do loans. Who would have thought? So capacity issues are causing these lenders to essentially price their rates higher and ignore the mortgage-backed security candlesticks and simply just let everyone know that, hey, we're not really looking for new business right now. Now, that'll come back. These loans will get processed, they will get caught up, and this will happen. But in the meantime, just be aware of that. I want to close just this video. It's gone a little bit long here. I'm Jason Gordon, AmeriFirst Financial. I want to thank everyone in the business who has been working very, very hard. Our operations staff, our management, our marketing teams, our human resources at AmeriFirst have all been firing on all cylinders. They've been fantastic. Escrow, title, real estate agent partners. I want to give a special shout out to a few different people here. Eric Bowlby, our CEO. My loan coordinator, Laura Sevis, has been phenomenal. Lindsay and Jenny helping her out have been great. Of course, Andrea Jack has been phenomenal. Steve Travis, Randall Kaczynski, Robin Kasich, Shelley Wilson, List goes on and on. You guys and gals have been phenomenal. We appreciate you very much and all your efforts. And of course, to your families for all their putting up with all of your long hours. Do appreciate that. A couple disclaimers on here. Keep my compliance people happy. Nothing about this video was an offer to lend. There were no rate quotes. They were simply just discussing the marketplace. I'm giving no legal or tax advice. I'm not telling people to not make their mortgage payments. I'm letting you know that there's a cause and effect for everything that you do and don't do. I will give more updates as we go forward. I appreciate if you've heard me speaking this long. I appreciate you sticking with me. And I want to wish you and your families nothing but the best of health moving forward. Thanks, guys. Take care. Bye.